there, I'm Rachael, the founder of Willow Financial Services. Just like a willow tree, your finances need to be strong, adaptable and well-rooted. Today, let's explore pensions and see how they fit in the growth and resilience of your financial tree. Let's begin with the basics. Pensions are simply plans that pay an income to you during retirement. In the UK, we have three main types of pension: the state pension, the defined benefit, and defined contribution. Each type works differently, and understanding these differences is key to planning your retirement. We'll begin with the state pension. This is a regular payment paid to you by the government, and that's available once you hit state pension age. This is currently 66, but rises to 67 or even 68 depending on your own year of birth. The amount that you will get hinges on your national insurance contributions. You need a full record of 35 years to obtain a full state pension. If you have less than 10 years contributions to national insurance, you won't receive any state pension at all, whereas between 10 and 35 years, you would receive a proportional benefit. Now, certain state benefits, such as child allowance, job seekers, carers allowance, or universal credit, can also earn you national insurance contributions. You can check online to see your current national insurance record, and if you are missing any years, it may be possible to make these up. Defined benefit pensions are also known as final salary or career average pensions. These are special workplace pensions where, instead of accumulating a pension pot with a monetary value, you're guaranteed an income for life. The amount of income you will receive is based on your final or average salary over your period with the employer, hence the final salary nickname. Some of these schemes will also offer a tax-free lump sum, with the specifics outlined in your scheme. These types of pensions are reliable and enduring, just like the roots of our willow tree, giving you financial stability in retirement. Defined contributions are the most common pension type today. Here you save a monetary pot over the years which is invested until your retirement age. It can be accessed from age 55, although again this age is rising in line with your birth year. You now have more choice and flexibility in how and where your pension is invested, and it's important to understand your options because what you decide with that will affect the retirement income for the rest of your life. So let's talk about automatic enrolment. This is a scheme the government put in place a few years ago to encourage more people to save into a pension. If you're an employee working in the UK, aged between 22 and state pension age, and you're earning above £10,000 a year, your employer must offer you a pension. They will contribute 3% of your pensionable earnings, with you contributing 5%. Now, those who don't want to join the scheme can opt out. However, every 3 years you are automatically re-enrolled. Now, if you're employed and you don't meet those criteria, you can still ask to join the scheme, although your exact circumstances will depend on whether or not your employer has to contribute. Look out for a specific video on auto-enrolment where I will go through all of this in more detail. If you're self-employed, this safety net doesn't apply to you, leaving many without adequate retirement savings. So please make sure you are addressing this as a non-negotiable business expense. When you contribute to a pension, the government will top this up with a tax credit of 20%, even if you are a non-taxpayer. If you're a higher or additional rate taxpayer, you will need to apply for a rebate on that extra 20 or 25%, usually via your tax return. Any growth within a pension is free of capital gains tax. Pensions are one of, if not the most, tax-efficient ways of investing for your future. Let's talk about taking your pensions, starting with those defined benefit pensions. When you reach the scheme retirement age, the pension company will write to you with your options. And this will usually include either a set pension or a lower pension amount with a tax-free cash sum. The scheme will set the maximum amount available and the cash commutation factor. If you are married at the time you start taking those retirement benefits, then this scheme will usually include a reduced pension for your spouse should you die before them. Moving on to a defined contribution scheme. With a DC scheme, you have plenty of options. You can take up to 25% as a pension commencement lump sum, tax-free, which is more commonly referred to as your tax-free cash. And then you have further options for the remainder of that money. Option 1, you can buy an annuity, which means you're securing a regular guaranteed income for a set period of time. This can either be for the rest of your life or for a number of years. It's reliable and it's constant, but it's also inflexible. Once you've chosen this path, you can't change it later. And the downsides is that your income may not keep pace with inflation, and the initial sum used to purchase the annuity is lost upon death, meaning that there's nothing to pass to your loved ones. Option 2, you can opt for flexible access, which allows you to withdraw sums from your pension in a way that suits you, whilst the rest remains invested. This method offers flexibility and the potential for growth. It also allows for any unused monies to pass to your elected beneficiaries. It makes a pension a powerful estate planning tool. However, with this flexibility also comes risk. The value of your pot can fluctuate with the market, and there's a danger of withdrawing too quickly from your funds if not managed wisely. Choosing between annuities, flexi access drawdown, or even a blended solution of the two is a crucial decision. As with all financial decisions, it's important to consider your personal circumstances, your goals, and your risk tolerance. At Willow Tree Financial Services, we're here to guide you through the right choices, helping you to find the right balance for your financial tree to flourish. Retirement planning isn't just about pensions. People are also using ISAs, bonds, property and other investments to support their retirement income. And with semi-retirement becoming more common, it's important to consider how these different assets can combine to provide you the retirement income that you've worked for. We help you envision and plan your desired retirement lifestyle, whether it involves travel, supporting your children, or any other goals you may have. And here's the compliance bit. Willow Tree Financial Services is a UK-based FCA-regulated firm. Therefore, the information in this video is aimed at UK residents. The value of pensions and investments and the income they produce can rise as well as fall. You may get back less than you invested. Tax treatment varies according to individual circumstances and is subject to change. To conclude, pensions can be complex, but understanding your pension options is vital for a secure retirement. Just like a willow tree, your financial journey requires care, planning, and the right conditions to thrive. At Willow Tree Financial Services, we're here to help you plant the seeds of a secure financial future and nurture your financial tree to full bloom. We have useful guides on our website that can help you with your financial planning. Please also follow us on social media for more hints, tips and guidance. Remember to like, share and subscribe for more insights into your financial journey. I'll see you next time.